This is something we've been noticing here at Bloomberg for a while, and the Fed doesn't seem to, not that they don't see it, but they don't seem to really care that much. It's interesting.
You've had a couple Fed speeches the past couple weeks, including New York Fed President Dudley, and I think your question is exactly on point. They acknowledged it, but they didn't seem overly concerned. I think everyone's right now talking about the dollar's strength, and certainly the past couple months the dollar's been strong, but from a longer-term perspective, the dollar's still at a fairly weak level.
Now, I'm a bit of a cynic, and growing up, I've always thought it was funny that the Fed seemed to have a policy of weakening the dollar as much as possible to boost our exports, and then go out and say, we have a strong dollar policy, and Treasury would say the same thing, but you knew they were lying. Do they now really have a strong dollar policy?
Well, I mean, the Fed would never admit that they touch the currency. They'd say that's in the purview of Treasury. Obviously, with quantitative easing and other Fed policies, they affect the currency. I think they think of how does the currency affect the real economy, output, job growth, and inflation. That's what they're focused on.
So we are expecting Fed, most people that we talk to are expecting the Fed to raise rates. How will a stronger dollar affect that? I mean, if we continue to see the dollar strengthen, how does that play into the inflation and rate change?
So you can think of the dollar as having somewhat of kind of counterbalancing effects. So to the extent the dollar strengthens, that means inflation comes down a little lower. We're importing things cheaper. It's also maybe a little bit of a headwind to growth for exporters. Keep in mind, though, the U.S., we don't trade as much as other countries, so a stronger dollar doesn't hurt us as much as some of the other exporting nations.
And we see a lot of those other exporting nations doing the reverse of U.S. Fed policy. I mean, people expecting more QE from Europe and even the Bank of Japan, right?
Exactly. So, Japan is the classic example of an export-led economy. They want a weaker yen to help the export recovery, to help the Abenomics kind of plan go through. In Europe, it's to some extent exports, but it's also the currency was just painfully high back at 140. And if the Eurozone is going to continue and go on as a going concern and hopefully recover at some point, they needed a weaker currency. That's what Draghi saw.
Are they the most flagrant currency manipulator of the big three, the Japanese?
Probably, because they actually talk about it and target it. But you know what? Draghi started talking about it and targeting. I think all the countries do it at various times, at various points in time. They're probably all the most flagrant.